You wake up, you check your account. The balance is still there, but the transaction doesn't go through. The system pauses. A message appears. Verification required. Review pending. Authorization needed. Your money exists. Your access does not. If the funds belong to you, why does using them require approval? If ownership is guaranteed, why can permission be withdrawn? And if the system is stable, why is access mediated at all? The contradiction is quiet but structural. Modern money does not move freely. It moves through permission networks. What appears to be personal ownership is, in practice, a conditional relationship with institutions that administer the financial system. Access to money is not simply a matter of possession. It is a function of authorization. And authorization can change. This is not a technical glitch or an isolated policy choice. It is a consequence of how modern banking and monetary systems are constructed. In a highly digitized, highly regulated financial architecture, the movement of money is governed by layered systems of oversight, compliance, liquidity management, and institutional risk control. What most people call their money exists inside those systems, and systems require permission. To understand how permission became central to modern finance, it helps to start with a simple fact about deposits that is rarely discussed. When money is placed into a bank account, it does not remain stored there as property under custody. Legally, the bank becomes the owner of the funds. In exchange, the account holder receives a claim, a promise that the bank will repay the amount on demand. This arrangement forms the basis of modern banking. The deposit becomes a liability of the bank. The bank is free to deploy those funds as part of its operations. Loans are issued, securities are purchased. Liquidity is managed across portfolios and markets. Your balance is not a physical reserve waiting for you. It is an entry in a system of obligations. Under normal conditions, this distinction feels abstract. Payments clear quickly. Withdrawals occur without hesitation. Transfers move instantly through digital networks. The system feels like ownership. But the legal reality is different. A claim is not the same as possession. And claims are governed by rules. Those rules exist to protect the stability of the financial system as a whole. They determine how banks manage liquidity, how regulators oversee transactions, and how institutions respond when risk appears. Most of the time, these rules operate invisibly. Occasionally, they become visible through a simple interruption. Permission required. This phrase can appear for many reasons. Anti-money laundering checks, fraud detection systems, sanction screening, internal risk assessments, liquidity management policies. Each of these mechanisms has a rational purpose. Each is designed to prevent abuse, crime, or systemic instability. But collectively, they reveal something deeper. Access to money depends on institutional approval. Modern payment networks are centralized infrastructures. Whether a transaction is made through a bank transfer, a debit card, or an online payment processor, it passes through systems that evaluate and authorize the movement. Algorithms assess risk patterns. Compliance systems screen identities. Clearing networks confirm settlement. At every stage, a gate exists. The gate is rarely noticed because it usually opens automatically. Yet the gate exists. The idea that money flows freely through the economy is largely a product of routine. When routine holds, permission feels invisible. When routine falters, permission becomes explicit. Financial institutions maintain extensive monitoring systems designed to detect irregular activity. Transactions outside expected patterns can trigger automated reviews. Transfers above certain thresholds may require additional documentation. From the institution's perspective, these safeguards are essential. They prevent fraud, money laundering, and illicit financial flows. From the individual perspective, they reveal a structural asymmetry. Institutions control the network. Individuals participate within it. Participation requires compliance with rules that may change over time. This asymmetry becomes more pronounced as financial systems grow more complex. Global banking operates within overlapping regulatory frameworks. International payment systems coordinate with national regulations, sanctions regimes, and cross-border compliance standards. A transfer that appears routine to a customer may involve multiple intermediary banks, each applying its own verification procedures. Any one of them can pause the transaction. The money still exists. Permission has been interrupted. The deeper mechanism becomes clearer when viewed through the lens of systemic risk. Financial institutions do not merely process payments. They manage exposure to credit risk, liquidity risk, operational risk, and regulatory risk. Every transaction passing through their systems affects these calculations. If risk thresholds are exceeded, institutions adjust behavior. Accounts may be reviewed, limits may be imposed, transfers may be delayed. From the perspective of the financial system, these actions are preventative. They prevent instability before it becomes visible. The logic is structural. When a bank processes payments, it is not only moving numbers on a screen. It is moving liabilities through a network of other institutions. Settlement requires coordination between multiple balance sheets. Liquidity must be available at the precise moment the transaction clears. If uncertainty arises, institutions slow the flow. Permission becomes conditional. Historically, this conditionality was less visible because money also existed in physical form. Cash transactions required no authorization from a digital network. Banknotes could move directly between individuals without intermediaries. But the role of physical cash has declined steadily in modern economies. Digital payments dominate, and digital systems require authorization. This shift has profound implications. When money becomes primarily digital, access to it becomes inseparable from the systems that administer it. Banks, payment processors, clearinghouses, and regulatory networks collectively govern how and when transactions occur. Control over infrastructure becomes control over access. This control is rarely exercised dramatically. More often, it appears in subtle ways: withdrawal limits, transaction flags, temporary account restrictions, documentation requests. Each of these interventions is procedural. Each reinforces the same underlying principle. Permission governs movement. The consequences of this structure become most visible during periods of financial stress. When confidence weakens in the banking system, authorities sometimes restrict withdrawals to prevent bank runs. These restrictions are not intended as confiscation. They are meant to preserve stability while institutions reorganize their liquidity. Yet from the depositor's perspective, the experience is simple. Access disappears, the balance remains. Permission is withdrawn. Historical examples reveal how quickly these mechanisms can activate. During the banking crises of the early 20th century, governments closed banks temporarily to halt runs on deposits. During currency crises in emerging economies, authorities have imposed withdrawal caps or transfer limits to protect reserves. These measures are extraordinary, but they are not improvised. They exist in legal frameworks long before they are used. The same principle appears in modern regulatory structures. Banks are required to monitor account activity continuously. Suspicious transactions must be reported. Accounts linked to sanctioned individuals must be frozen immediately. Compliance systems operate automatically. A match in a database can halt financial activity instantly. Again, the money remains recorded. Permission is revoked. These systems are expanding. Advances in financial technology allow institutions to analyze transactions in real time. Machine learning systems detect patterns that human analysts might miss. Regulatory reporting networks coordinate information across borders. The result is a financial infrastructure capable of monitoring and controlling flows of money with unprecedented precision. Precision improves security. It also increases control. Most people encounter this control only briefly. A temporary card decline, a verification request, a flag transfer. The system resolves the issue quickly. Routine resumes. But the interruption reveals something structural. Access to money is mediated by institutions, whose primary responsibility is system stability, not individual convenience. When those priorities conflict, stability prevails. This does not mean that the system is malicious. It means the system has priorities. Financial systems exist to facilitate economic activity while minimizing systemic risk. To achieve this balance, institutions must retain the ability to intervene. Intervention requires authority. Authority requires permission. This architecture has evolved gradually over decades. Each regulatory reform, each technological upgrade, each crisis response has added another layer of oversight to the financial system. None of these changes alone appears transformative. Together, they reshape the nature of money. Money becomes less like an object and more like a controlled access system, a digital ledger entry governed by rules. Those rules define when transactions are permitted, when they are delayed, and when they are denied. The majority of the time, the rules operate quietly. Transactions flow normally. Accounts function without interruption. Confidence persists. But beneath that routine lies a framework designed to pause the system when necessary. The pause does not signal collapse. It signals control. Control ensures continuity. Continuity preserves trust. Yet the mechanism remains the same. Permission. The final recognition is subtle. Ownership in a digital financial system is not absolute control over assets. It is the ability to access and use claims within an institutional network. That network operates according to rules designed for collective stability. Those rules can change. And when they do, the change does not always arrive with an announcement. Sometimes it arrives as a brief message on a screen. Transaction declined. Verification required. Permission needed. The money is still there, but access now depends on approval. And that approval was always part of the design.